this overview, we'll look at a contrarian investing model that incorporates multiple value metrics. This is based on David Dremen's book, Contrarian Investment Strategies. Here's the key fundamental investing insight behind this strategy. Investors are prone to predictably and systematically overreact to bad news, and you can profit from those overreactions using a contrarian investing approach that identifies out-of-favor companies with improving fundamentals. The strategy looks for undervalued companies using a series of valuation metrics. It then separates out those companies with the best future prospects by looking at signs of financial strength, which include high current ratios, high returns on equity, high pre-tax margins, and low debt to equity ratios. Dremen at one point ran one of the best performing mutual funds during his tenure. From 1988 to 1998, the Kemper-Dremen High Return Fund consistently ranked as one of the top funds in its peer group. The investment thesis behind the strategy is this: patient investors can profit over the long term by going against the herd and buying stocks of deeply out-of-favor companies that other investors are shunning. Okay, let's take a look at the model. As I mentioned, this contrarian investor model is based on the book Contrarian Investment Strategies by David Dremen. The first step is to avoid companies that are more susceptible to accounting tricks and gimmickry. To do this, Dremen focused on the largest stocks in the market because they were more in the public eye. So the screen starts out by identifying the 1,500 largest stocks in the market by market cap. Next, it looks at the trend and improvement in earnings. So what the model does is it looks at the past 2 quarters to see if the trend in earnings is positive. It also looks at the trend relative to the market. The next step in the model, and this is really the core valuation and contrarian aspect of the strategy, is the model looks at 4 different valuation metrics and requires that companies pass at least 2 of them. So specifically, the model looks at a company's PE ratio, its price to book ratio, price to dividend, and price to cash flow. And what it wants to see here is at least 2 of those ratios are in the lowest 20% of the market. By doing this, it can determine that companies are trading at low valuations, and it's an indication that investors have shunned the company, giving the contrarian investor an indication that the stock has been neglected by investors. The model then goes on to assess a company's financial strength position. So what it looks at here is things like return on equity, the company's payout ratio, and whether or not dividends can be increased over time, a level of profit margins of at least 8%, and a debt to equity ratio of lower than 20%. The last criteria in the model is to look at the dividend yield. A high dividend yield is good, but more importantly, it wants to see dividend yields that can be maintained and even possibly increased over time. The contrarian investor model provides investors with a way to find beaten up, contrarian-like investment ideas that have elements of financial stability and improvement in their fundamentals.